To talk more about whether this global up move can continue, Marc Faber joins me now. Marc, thanks for joining in. Good morning. The world markets have been swinging wildly between risk on and risk off. What do you think is going to be the more dominant theme in the near term?
In the near term, I believe that markets can still rally somewhat for the simple reason that in every market you have a few strong stocks. And they are breaking out on the upside, and then you have a lot of stocks that are down 40–50% and very oversold, so they can also rebound. And we have a lot of liquidity in the world that has been created essentially by central bankers. We have negative real interest rates practically everywhere, so if people keep their money on deposits, they're losing out in terms of purchasing power. And the mood, the sentiment among investors was, as of the beginning of June, very negative when the S&P bottomed out. And so I think that we may still rally somewhat into August, mid-August, end of August, and then probably we'll have a tougher second half. In other words, September, October, November could be somewhat tougher months.
So if you were to just put numbers to this, the S&P closed on Friday at 1390. How much would you give it in the case of an up move?
Well, the high was this year on April 4th at 1422, and I think it's possible, based on the few stocks that are strong and the rebound candidates, that we will exceed that high, that maybe we move to 1450 or even 1500. But you understand, the difficulty at the present time is, on the one hand, you have ultra expansionary monetary policies, zero interest rates in real terms, and you have a slowdown in the global economy. At the present time in Asia we have practically no growth. In Europe we are in recession. In the US there is very little growth. So you are, on the one hand, faced with a lot of incoming liquidity created by central banks, and at the second time, on the second hand, you have essentially a global economy that is slowing down, where corporate profits will rather disappoint than exceed expectations.
So would you be a seller in the strength over the next few weeks, and do you see the levels of the June lows that you alluded to being broken in the September to November phase?
Yeah, I think these lows could be exceeded, and I think that in maybe October, November, or after the US election, we could have essentially a decline of around 20% in the market.
Do you think the euro has seen its low against the dollar for the near term, or do you see the weakness coming back there?
Yes, for the near term, probably, and probably for the wrong reasons. But the one thing I want to say about Europe, for the first time in my life, I have been buying some European shares, because if you look at the markets of Portugal, Spain, Italy, France, Greece, they are either below the 2009 lows, that would be the equivalent on the S&P at 666, or they are approaching these lows. So you have a lot of reasonably good companies that are very, very inexpensive. And as a contrarian, I think that there is some value in some of these companies.
Okay. What's your view on gold right now, Marc?
Well, I mean, this is a controversial subject because some people think it's a bubble. My view is it's not a bubble, but it's obviously at a fair price here. I think we can still move up somewhat, maybe, another 10–20% in the next 6 months, and then we'll have to see. But I believe that investors will be faced with more and more regulation and scrutiny, and that to own some physical gold is an insurance that is an absolute necessity.
How about India, which is pretty much in the same kind of description that you outlined, which is that macro is weak, Fundamentals are not great, but liquidity is keeping stock prices higher. Do you see that it continuing that way in the foreseeable future?
Yeah, I think we can also rebound here somewhat, but I would use essentially strength in Asian emerging markets that have actually, and India is not in that category, but say Indonesia, the Philippines, Thailand, and so forth, they have performed actually very well over the last 12 months. And so I would use strength here as an opportunity to lighten up on positions. But it all depends on each individual investor. If someone has all his money in equities, I would be aggressive seller at this level and on any rebound. And if someone has only 20% in equities, I wouldn't worry about that. My approach is to have a diversified portfolio at this stage.
Thanks, Mark. Good talking to you.